This is the story of how Benjamin Graham, the father of value investing and the mentor and teacher of the most successful investor ever, Warren Buffett, made his first $1 million. You will understand the events, characteristics, and investment strategies that took a broke immigrant boy without a father from 0 figures to 7 figures. Not to mention, Graham accomplished this during the worst bear market in history. Even though most of this story takes place almost a century ago, surprisingly many of Graham's actions and ideas can be applied in the ambitious person's own journey towards financial freedom today. Let's dive in. This is the Swedish Investor, bringing you the most in-depth descriptions of stock market legends. Graham the Grossbaum. Benjamin Graham, or Benjamin Grossbaum as he was then named, was born in May 1894 in London. Many things happened early in little Ben's life that didn't precisely spell fortune and millions of dollars in the stock market. Firstly, his Jewish family moved to New York when he was little. A family of entrepreneurs, the Grossbaums thought the other side of the pond would prove more fertile ground for business development. However, their fortune would take a terrible turn when Ben's father, Isaac Grossbaum, died in 1903. Ben was just 9 years old. After the incident, he and his older brothers Victor and Leon took whatever jobs they could find to make ends meet for the family. The US was a land of optimism at the time, though. Janet Lowe describes it well in her book Benjamin Graham on Value Investing. High-tech stuff like the typewriter, the sewing machine, the self-binding harvester, and especially the automobile surely would make life glorious for everyone. Graham's first taste of Mr. Market. When Ben was 13 years old, in 1907, he had his first experience in the stock market, which could have been better. His widowed mother Dora had purchased a stake in US Steel, but the timing couldn't have been worse. It was 1907, and soon enough, a panic broke out on Wall Street. The family's shares were down by 49%. The market quickly recovered, but that didn't help poor Dora, who, in a family with only a single income, had little staying power. Mr. Market 1, Ben 0. Mr. Market had won the battle, but, spoiler alert, Ben was going to win the war. Graham the college graduate. On the 3rd of June 1914, when Ben was 20 years old, he graduated from Columbia University in New York. He faced 2 major challenges before accomplishing this feat. Firstly, he wasn't immediately accepted to the school. After finishing high school, Ben took a national test and scored poorly. Ben had always been a bright student, and everyone was surprised by this failure. Meanwhile, a relative of Ben, with the exact same name, got one of the highest grades ever scored on the test. Later, it would be revealed that their tests had been mixed up. Because of this incident, Graham arrived later than his classmates that first semester. But that wasn't going to stop him. What almost did stop him, the second challenge for Ben at Columbia, was that, at the time, all graduates had to pass a swimming test. Ben had brains, but no experience in the pool. A few weeks of training sealed the deal, though. What about Ben's first million? It hadn't even started to accumulate yet. So, compared to, for example, Ben's Padawan Warren Buffett, Ben had quite the rough start. His brothers and a part-time job at US Express helped him with the tuition fees. Graham and Antisemitism. When World War I broke out in Europe in 1914, the US became highly anti-German. Sauerkraut was renamed Liberty Cabbage. Hamburgers, oddly enough, they do not come from the US, which I thought, but from the German city Hamburg, became Liberty Steaks, and pretzels were banned from lunch counters. The country wasn't free from anti-Semitism either, and the Grossbaums, who had a Yiddish or German surname, felt the strain. Therefore, Benjamin Grossbaum became Benjamin Graham during these tumultuous times. Graham and Wall Street. Graham was offered jobs as a teacher at Columbia by 3 different departments: mathematics, philosophy, and English. What about economics, you may ask, with the benefit of hindsight knowledge? Well, Graham had dropped out of the only course he had taken on the subject. I think this makes the events that were to unfold quite hilarious. Puzzled with the difficult decision to choose English, mathematics, or philosophy, which one am I most interested in? Graham went to the Dean of Columbia, Frederick Keppel, for some counseling. As Graham himself puts it in his memoirs, he had a strong prediction for sending bright college graduates into business instead of shutting them up in the ivory tower of academic life. Said and done, Keppel strayed Graham away from his own institution and landed him a job at the brokerage firm Newburger, Henderson and Loeb on Wall Street. Graham and Newburger. During this time, Wall Street wasn't as glamorous as it is today, and Graham's entry position earned him a whopping, hold it, $12 per week. At this pace, Graham would reach his first million by age 1622. And since we wouldn't have time for such a long story, we're lucky that he soon found some more lucrative ways of making a buck. Graham was making massive progress at work, but unfortunately, during these first years, he was up against an even more massive headwind. He worked hard as a runner, delivering checks and securities, and within a month, he advanced to assisting in a bond department, describing bonds that Newburger thought were interesting. This greater responsibility would likely have been accompanied by a more extensive paycheck, hadn't someone shot a certain archduke in Europe. The breakout of World War I was a fact, and so was a panic on the New York Stock Exchange, which shut down for 5 months. Graham's salary was cut to $10 per week. Now it was 1,942 years until that first million. Graham showed a true talent for dissecting the numbers of accounting sorcerers, and when one of his bond reports accidentally made its way to a competing firm, Bach & Company, they immediately wanted to hire him. They offered $18 a week, a massive 80% hike in salary. His boss made a counteroffer, where Graham was made in charge of the new security analysis department. During this time, he also published several articles in the Magazine of Wall Street, primarily about bonds. The magazine liked his pieces so much that they offered him a well-paid position as the editor. Once again, his boss Newburger made a counteroffer, and so, in 1916, Graham's salary was at $50 per week. In addition, he was promised a future position as a partner in the firm. I think now was the first time in Graham's life where he could actually accumulate some savings, so this will mark as the starting point towards that $1 million. Graham the tortoise was morphing into something of a hare by being a reliable co-worker at his firm. You know that the takeaway from that story is that it's better to be a tortoise, right? Really? Well, what else is faster than a tortoise? A raccoon? Graham and the antithesis of value investing. Graham would make several important discoveries about the ins and outs of Wall Street during his years at Newburger, discoveries that would be pivotal in forming a more sophisticated theory on stock market investing. Graham said that in the early days of Wall Street, most didn't draw a distinct enough line between their financial operations and racetrack betting. To the old veterans on Wall Street, it seemed silly to analyze and gather financial data when what actually mattered, according to them, were human factors. The famous they that were responsible for all large movements in stocks. What was important was being first knowing what they would do next. As Graham said, their intelligence had been corrupted by their experience. Graham would change this style of thinking by bringing a much more scientific touch to security analysis. He wanted to separate investing and speculation once and for all. Graham the money manager. Being a good student at Columbia came with benefits. Not only did it land Graham his first job, it also landed him his first investing client. He had earned the trust of his old professor in English, who set Graham up with his first $10,000, and a really beneficial deal where they would split the investment profits 50-50. This would be Graham's first taste of real success. Early on, he was able to pull several $1,000s of profits from the partnership, but it would eventually turn on him when the markets got sour in a peace scare. Crazy! Mr. Market was pushing down stock prices because there was talk about ending a world war? You just can't trust this guy. Graham and his old professor agreed that Graham should pay back the loss in the account at a rate of $60 per week. These were the things that kept Graham up at night. What had gone wrong? And what could he do to improve the next time? Graham the junior partner. In 1920, at age 26, Graham became a junior partner at Newburger, with a 2.5% interest in the profits of the business without liability for losses. According to his memoirs, my share in the profits ran at about $5,000 per annum during the 4 years that I enjoyed it. By now, Graham had probably begun to forget about his poor childhood. The wind of change was blowing. The stock market was now entering the roaring 20s, and Graham's reputation as an innovator within arbitraging and hedging grew. He was fearless in investing in deals that looked pretty complex to the general public, such as buying bonds and preferred shares with convertible privileges. We'll examine the 4 areas Graham exploited to beat the market soon. Graham plus Harris equals to Grahar. With Graham's growing reputation came a growing interest in using his service as a money manager. Graham was approached by a man named Lewis Harris in 1923, who came with an offer. I'll give you $250,000. You guarantee me a 6% return, and you'll get 20% of the profits above that. Plus, I'll give you a $10,000 salary. Whoa, a $10,000 salary and profit sharing? What was Newburger's counteroffer going to be this time? Actually, the 3rd time's the charm, and Newburger had to let Graham go at this point. Graham had additional motives besides this lucrative deal. Quote, for a long time, I had felt that I did not belong in the brokerage business, which repelled me at bottom because I felt, then at least, that I could prosper only at the expense of its clients' losses. So, in June 1923, Graham became a manager of $250,000 from a major investor, plus $250,000 in additional capital from the FFF, Friends, Family, and Fools. The really observant viewer would notice something interesting about these numbers. $500,000 in assets under management, $10,000 per year in salary, and 20% of the profits? That's awfully similar to the 2 and 20 fee agreement that is standard in the hedge fund industry today. Actually, even though Alfred W. Jones is credited with coining the phrase hedge fund, and with creating the first hedge fund structure in 1949, Graham was way before him in a sense.
So if you read any place that the hedge fund concept originated in 1949, presumably with A.W. Jones, it's not an accurate history.
The company's name was the Grahar Corporation. Graham plus Harris equals to Grahar. In a 1955 hearing, Graham said that my own participation was very small. I had very little money. So, Graham had yet to make any real leaps towards that first million, but he was soon going to. Graham and the joint account. These days, the 2 and 20 fee structure would be considered quite expensive with the emergence of index funds, etc. But in Graham's days, it wasn't really. People told Graham that he should up the ante with Lewis Harris. Said and done, Graham suggested a new fee structure for the corporation. I'll skip the salary, but in return, I'd like to make 20% of the first 20%, 30% of the next 30%, and 50% of everything above that, before your guaranteed return of 6%, of course. I don't want to spend too much time on these mathematics, but let's just say that this was an explosive setup for accumulating wealth for Graham. But it was declined by Lewis Harris. And so, the Grahar Corporation was restructured without the principal investor in January 1926. The new version was called the Benjamin Graham Joint Account, and the initial capital, even without Harris's participation, was $450,000. Now Graham had a sharpened wealth accumulating sword. But without the salary, it could cut both ways. In fact, he was just about to. Graham the Teacher. Ben's articles in the magazine of Wall Street had been such a success that he began to consider a larger project. A vague idea about a book that would lay out the foundational principles of investing. He thought teaching a class would be optimal for organizing material and testing his presentations. In 1927, he began teaching advanced security analysis at his old college, Columbia. The class was completely swamped. In retrospect, it is easy to understand why. They were near the top of one of the greatest bull markets in history. Graham just shy of $1 million. Graham's first few years as a money manager couldn't have been better. The Roaring Twenties was called so for a reason. While 1926 showed only a mediocre return of 4% in the general market, 1927 ticked in at 28%, and 1928 returned a mouth-watering 50%. And Graham and his shareholders did even better. The joint account traded in arbitrages, bargain issues, liquidations, and related hedges, which we'll get to really soon. And it did so using a margin of around 40 to 50%, meaning Graham had borrowed money to invest in one of the strongest bull markets in history. The account on Graham's personal wealth completely exploded. Kahn and Milne writes the following in Benjamin Graham, the Father of Financial Analysis. The year 1928 was the last full year of the bull market, with a 51% return for the Dow Jones Industrials and a 60% return for the joint account, after Ben's share that exceeded $600,000. In Graham's memoirs, there's a chapter titled The Great Bull Market of the 1920s. I became a near millionaire. At this point in his life, Graham was convinced that he knew it all. He thought he had Wall Street by the tail. He thought about the luxuries that he would soon enjoy. A large yacht, a villa at Newport, maybe even some mistresses. Later, he'd say that he was too young then to realize his hubris, and he would pay for that. Graham flying too close to the sun. The Dow peaked at 381 in September 1929 and then dropped like a stone to just 41 on the ultimate bottom in July 1932. That's almost a 90% decline. Imagine that. Take whatever number you have in your portfolio right now and imagine someone just ripping away 90%. Ugh, the horror. There's never been another bear market like it. Had Graham stayed with his 40 to 50% margin, he and his investors would have been completely wiped out. It didn't start out well. Graham lost 20% versus 15% for the Dow in 1929 and 50% versus 29% in 1930. Graham would later call the year the by far worst in the 33-year history of my fund management. After this incident, Graham basically never borrowed money to invest in stocks again, and in 1931 and 1932, at least he did better than the rest of the investing community. Because of the way Graham's compensation in the joint account was arranged, he would go on without receiving a dime for 5 full years after the crash. This undoubtedly made a dent in his net worth, and it also changed the way he thought about material wealth. Quote, "The true key to material happiness lay in a modest standard of living which could be achieved with little difficulty under almost all economic conditions." He and the family had moved into an expensive duplex apartment at 81st Central Park West that cost $11,000 per year. And during the worst of times, they had to sublease it. Graham's call to arms. In 1932, Graham wrote a 3-piece series in Forbes titled, "Is American Business Worth More Dead Than Alive?" Here, he argued that, sure, in 1929 the stock market had been overvalued, but now, after a 90% decline, the situation was the complete reverse. More than 30% of the stocks on the New York Stock Exchange was selling for less than their net cash. This is insane, by the way. I screened for this real quick, and today, only 1% of the companies on the New York Stock Exchange are that cheap. And if you want them to be profitable as well, that's just 0.1%. Graham later referred to this period as the good old days, when we paid only for the present and could get the future for nothing. By 1935, the market had turned, and the losses in the joint account had been repaid. Graham and security analysis. Graham had thought about releasing his first book on the stock market before the 1929 crash, but later said that it was lucky that he didn't. The book wouldn't have been complete without that experience. In 1934, Graham, with the help of David Dodd, released what may now be considered as the Bible of value investing, Security Analysis. It added greatly to the investing community's knowledge and to Graham's net worth, as it sold over 100,000 copies during its first 40 years. His book sales would be one of 3 vehicles that would carry him back out of the bear market to his first $1 million. Graham and the Graham-Newman Corporation. Graham wasn't really the leader or management type of guy, and he went out looking for someone who could take that responsibility off his shoulders. He wanted to focus on investing, not pampering clients. He found Jerry Newman, the brother of a childhood friend, and they worked so well together that Graham offered him a 50-50 deal in the joint account. After the IRS questioned the joint account's status as a partnership, Graham and Newman formed a new corporation, the Graham-Newman Corporation, in 1936. This was the second of the 3 vehicles carrying Graham to his first $1 million. The deal was a salary of $10,000 to $15,000 and 20% of the profits after shareholders received a guaranteed 6%. The assets under management at this point was around $3 million. So, just like with the hedge fund, Graham was first, contrary to conventional wisdom. The original Ben & Jerry was not founded in 1978, but in 1936. Mostly, Graham and Newman got along really well, but they couldn't get away from the fact that Graham was a practitioner and a teacher, while Newman was a pure businessman. Graham would often spill the beans about what holdings they had in their portfolio to teach from example in his class at Columbia. The class then bought the stocks, bidding up their prices so that Graham and Newman could no longer buy them at the bargain levels they wished for. Newman was furious. Graham's 4 market beaters. In the 1946 letter to shareholders of the Graham-Newman Corporation, Graham and Newman list how much of their capital they have in each of 6 different categories. 4 of them were especially interesting, as Graham later described in The Intelligent Investor. Let's look at an example from each of them so that we can really get inside the head of the father of value investing. Arbitrages. Rockwood & Company wanted to sell off a large cocoa bean inventory because prices had recently soared in the commodity. The issue was that it would incur a 50% tax if it was just sold in the normal way. A loophole in the tax code allowed the company to create an ingenious plan to avoid this. Rockwood offered to repurchase its stock in exchange for the cocoa beans, £80 per share. Since the share sold for less than 48, which was the value of 80 pounds of cocoa beans at the time, an unusual opportunity appeared that Graham/Buffett, who was working for Graham-Newman at the time, seized. They bought Rockwood shares and exchanged them for beans, which they immediately sold, pocketing the difference. Buffett said that the only real expense was subway tokens, as physical certificates had to be transported to different areas of New York. Bargain issues. Northern Pipeline was selling at $65 per share and paid $6 in dividends, easily covered by earnings. In addition, as was almost always the case with Graham, he watched the balance sheet of stock market companies very closely. The company held high-grade bonds valued at $95 per share. This is a perfect case of limited downside and high upside. The dividend and the bonds should limit the downside, and simultaneously, if the company would liquidate the bonds and give a special dividend to shareholders, there's a massive upside. This happened in 1928 when shareholders received $70 per share in dividend plus the share had appreciated to $100 each. Liquidations. Guggenheim Exploration Company held a lot of assets in other listed companies, and it had recently announced that it would dissolve. It would sell its assets and distribute them to the shareholders. The price of the shares was $68.88 each when Graham purchased, and he thought the value of the company's assets was $76.23 per share. In other words, it appeared that he could make $7.35 per share. It didn't take long either. Just 4 months later, he had made that 11% return. If you think that this sounds similar to Northern Pipeline and bargain issues, you are totally correct. The difference is that in a liquidation scenario, the course of action has already been announced, and the most important question for the intelligent investor is, how long will my money be tied up before the payout? Related hedges. Paramount Pictures Corporation had issued a preferred share with $6 in dividends that, at the time, was convertible into 7 common shares. The common share is just your normal share, by the way. At a certain point, the preferred share sold at $113, against almost $16 for the common. So, just the conversion privilege of the preferred share was worth $112 at the time. In addition, the preferred share had $12 in accumulated dividends, which had to be paid before the common stock could receive anything. Clearly, if the common stock was worth $16, the preferred share was worth at least $124. A shrewd investor could have bought the preferred and sold the common short, essentially betting that the price difference will shrink over time when Mr. Market realizes his mistake. Interestingly, Graham would switch between these 4 categories depending on whether he thought the general market was expensive. In 1943, for example, he thought the market was fairly low, and so he put more money in the bargain issues, which usually consisted of common stocks. When he felt the market was more expensive, such as in 1946, he moved money away from common stocks into special situations, such as arbitrages, liquidations, and related hedges. Why? Because results from these special situations were more or less the same, no matter if a bull market or a bear market was coming. Here's rare footage which tells us something about how Graham judged whether markets were high or low.
One of the comparisons that's interesting is one not between 1929, which is so long ago, but 1950, which is only a few years ago. It would be very proper to ask, why are prices twice as much as they are now when the earnings of companies, both in 54 and probably in 1955, are less? And the explanation cannot be found in any mathematics, but it has to be found in investor psychology. You can have an extraordinary difference in the price level merely because not only speculators, but investors themselves are looking at the situation through rose-colored glasses rather than dark blue glasses.
Graham the Intelligent Investor. Warren Buffett read Benjamin Graham's book The Intelligent Investor when he was just 19, and it established in him an investing framework that has lasted a lifetime. His comments about the book range from the fairly modest, "No one ever got poor by reading Graham," to the stronger, "By far the best book on investing ever written." I've listed the 3 most important takeaways from the book on the channel before, and I'm not sure that I can top that, so here it goes. Intrinsic value. A stock is a piece of a business, which means that it has an intrinsic or real value. Mr. Market. The stock market swings from too pessimistic to too optimistic. A true investor is not swayed by Mr. Market's unpredictable moods and merely sees rising and falling prices as an opportunity, not as a conveyor of information. Margin of safety. Decisions in the stock market must always be made with a built-in margin of safety. This means that you should insist on buying stocks with a large discount to their intrinsic or real business value. There is newly gained interest in the intelligent investor each time there is a bear market. In times of turmoil, the sound principles of the father of value investing will be your beacon. Graham and GEICO. The third and final vehicle that turned Graham into a millionaire was a shrewd investment in what was about to become one of the largest insurance companies in America, GEICO. Yes, that GEICO.
15 minutes could save you 15% or more on car insurance.
Everybody knows that.
Well, did you know certain cartoon characters should never have an energy drink?
Action.
GEICO.
Graham liked to own tons of stocks, often up to 100, but he also took occasional big bets when he was convinced that he was correct. Such was the case when he invested about 1/4 of the Graham-Newman Corporation's assets in a 50% interest in GEICO in 1948. The GEICO stock was distributed to shareholders in the same year because of a misunderstanding of the rules regarding ownership of insurance companies. Graham was the owner of about 1% of the company at the time. He even became its chairman between 1949 and 1957. And this was a tremendous ride. Graham describes it in the postscript of The Intelligent Investor. In fact, it did so well that the price of its shares advanced to 200 times or more the price paid for the half interest. And, ironically enough, the aggregate of profits accruing from this single investment decision far exceeded the sum of all the others realized through 20 years of wide-ranging operations. It is interesting that an investor who, after the 1929 crash, had become so cautious, would make this type of bet, and of course, also be proven right on it. You know what they say about opportunity and the prepared mind. Graham the Millionaire. Now, let's try to put this all together. We know book sales of Security Analysis and The Intelligent Investor. We know the results of the Graham-Newman Corporation and the fee structure that they used there, especially in 1946 and forward, where we have detailed numbers. And we know how the share price of GEICO developed. Combining these three vehicles, adding federal and state tax, and then estimating how much money Graham spent per year, my guesstimate is that he became a millionaire in 1953. There is no official record or anything, so I had to spend a lot of time in books, shareholder letters, and databases to make an educated guess. Also, it's important to consider that $1 million in those days are equal to something like $11.3 million today. Graham became a millionaire by getting a solid education, working his way up the ladder and becoming knowledgeable in his craft before setting up his own company, where he would profit big as long as the customers also did, sharing the knowledge he had accumulated through the years in books, and betting big when the opportunity seemed right, at a time in his life where he could afford being wrong. Limited downside, maximum upside. As stated in the intro of the video, such a course of action can be implemented today too, almost a century later. Now, check out this video on how another legendary investor, Charlie Munger, became a millionaire. If you do, please excuse my ignorance regarding American presidents. Cheers!